Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the Worry-Free Retirement with best-selling author and fiduciary Tony Walker.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do. Them that have it, get more of it. The less they need it, the more they love it. And it sticks to them like glue. Funny, funny, funny what money can do.
Welcome, folks, to the Worry-Free Retirement, and you are without the little man in the sweater vest today. Today you're with the favorite son-in-law and the favorite nephew, Wes. Good morning.
Good morning, Trey. How are you, sir?
Pretty good, pretty good. Yeah, I am Trey Juergens, fellow fiduciary here at Tony Walker Financial, and today Wes and I, the millennials, are taking over the ship.
That's right. That's right. Normally you're accustomed to hearing the little man in the sweater vest on here, Tony Walker, talking about retirement planning and everything that comes with it. But today you've got two smaller, less known fiduciaries, but good nonetheless. And we're here to talk about a variety of different things. But Trey, kind of what are we diving into today?
Yeah, so Tony thought with recent market events and the amount of interest with the short squeeze here lately, that we're going to get on here and pick some stocks, actually.
Really? Okay.
Yeah, we're going to get really aggressive and talk about short squeezes, options trading, and kind of how we can allow some savers to really look at some speculation.
Really maximize it. And, I think these annuities, they're all fun and good, but what we want to talk about today is how we can get 8,000, 9,000% returns. GameStop's still an option. AMC, who knows? It could go anywhere. But we're going to be the squawk on the street today, Trey.
Exactly. And anybody listening to this show obviously knows that we're completely joking.
Yeah, that's completely false.
We're here to talk to savers about saving. And options that we're really going to talk about today are CD alternatives.
Boy, nothing could be further from GameStop and options.
Yeah, anybody that's seen the news lately with the amount of speculative stocks and options trading and trading on margin and the stuff that's just above most fiduciaries' heads, to be honest. It's a way that the little guy on Wall Street's been able to make some money kind of going against the hedge fund managers, and really it's a lot of noise. And what we're really here to talk about is we're talking to savers about how to save money in a safe investment, and a lot of the times leaving that money for loved ones. It's not something they really want to put at risk. So
I'd say too, with all this stuff that goes on out there now, one key thing the millennials talk about is this FOMO kind of thing, that's fear of missing out. And I think when you hear your buddies and the people you know, your family and friends talking about these huge returns they're getting, oh, they're making money on Bitcoin or they're making money on Tesla, it's hard to get not swept up into that kind of craziness, that kind of frenzy. So it's important to talk about alternatives for when you're entering retirement, and it's really not about gaining any more money, especially if you've got a good asset base. Like we say, there's no real need to risk it. And we've got some good alternatives to CDs, which of course are pretty safe, but getting swept up into the frenzy of making money on Wall Street just isn't really what we talk about.
No,
here.
You're exactly right. And who we really work with are savers, and a saver by definition, I know Aaron is sitting over there producing this show. He's heard this 1,000 times, but a saver is someone more concerned with the return of their money than return on their money. They want to give someone, invest their money, but also get something back. They're not going to see it overnight swept away by some frenzy in the stock market that they thought they were going to hit it big.
And there's a chance too if you go out and do all these speculative things, you may not get your money returned. I mean, you think about the people who are buying GameStop when it got up to 300. Well, now it's down at 50 at the time of this recording. Where'd all that money go? I mean, it's gone, and it's probably unlikely that they'll get it back. So, agreed. It is important to talk about these alternatives to taking such risk.
Yeah, and then before we jump into those we have 3 CD alternatives right now. Obviously, these alternatives are not CDs because right now with federal interest rates so low, it's hard for anybody to find interest rates at a bank or bank type instruments at credit unions that pay anything. So before we get to that though, I want you to dive in. I know you've been doing a lot of work here on the Worry-Free Retirement YouTube and Tony Walker Financial YouTube page. Just quickly kind of go down, I jotted a list down of some of the ways that folks other than this radio show can digest just the pure volume of content that Tony's cranked out over 36 years. So just real quick, kind of explain some of these options of how people can find this info.
Sure. Yeah. So we may not have all the info on the latest speculative investment advice, but we do have something that's a little millennial-esque. We've of course got the YouTube channel, and it's got all of the previous shows of the Worry-Free Retirement. So if you ever wanted to go back and check out a past episode, they're all uploaded on there. We've got all of, a lot of clips from the show that are kind of segmented out in certain topics. Some are about insurance, some are about these CD alternatives, some are about annuities, just really all the things we do here that are kind of more in the planning process of retirement. And again, less into the speculative world of investing. But we've got a lot of resources there. And then also, of course, we've got our weekly email blasts. And Trey, you do a good job of doing things on the show and getting those set up. And then I send them all out to our email blast list. But what we'll do is each week we'll take a clip from the show, edit it out, and send that out to our email blast list. Just kind of as a reminder of the content we're putting out and what our ideas are. So if you do want to sign up for those, just shoot me an email. I'd be happy to add you to the list. It's wes@TonyWalkerFinancial.com. And I'll add you to that, and we'll send you some weekly emails on things that are going on in our world and kind of how the retirement process works and what all it is we do here.
Yeah, that's good. I think another thing I want to highlight on TonyWalkerFinancial.com, of course, that's the website. We've got absolutely a ton of educational materials. We've had this new booklet series. I know you've helped write some of these booklets too. What they've been able to do is just kind of take so much of what's out there on the internet and put it in booklet form, something we've got here at the office in printed copies. So if you do come in to see us, of course, we can give you one of those to read through, but you can download the PDF version online on our downloads page. Again, that's TonyWalkerFinancial.com. If you go to the downloads page, you can find the 5 most recent booklets. We're coming up with a 6th one. I have to work on that. Tony told me.
I know Tony's on your heels. He's snapping at you. Get that done.
Get cracking on it. I need to finish that draft so we can come up with something by next week. But the 5 we already have on there are Investments Made Easy. Obviously, that's one that a lot of people right now would want to dive into. Insurance Made Easy. You and I work here in the insurance department at Tony Walker Financial. Mm-hmm. Life insurance, long-term care insurance. I can discuss Medicare supplements and how to navigate that craziness. So that's another good one. Annuities Made Easy. Tony, of course, knows a thing or two about annuities, so any of our advisors here would be happy to answer any questions about that. But Annuities Made Easy is a booklet on the website. 401k Rollovers Made Easy.
That's a huge one, too.
It really is. I mean, people work 30, 40 years socking money away into this 401k. Going into retirement, it's one of their biggest assets, if not their biggest asset.
And two, just to interject on that point, one thing we find with these 401ks is just how risky they are. I mean, somebody getting close to retirement, maybe in their early 60s, late 50s, we'll take a look at those 401k statements a lot of times, and you're pretty exposed to what we call equities or just stocks. You're pretty exposed to the market. And, we don't try to time the market. We don't say our predictions on what we think the market's going to do. But looking over time, the market's pretty high right now. And if you're getting close to retirement, may not be such a good idea to be taking so much risk. So we're happy to look at 401k statements, get a gauge on how, risky that portfolio is. And then when we roll it into our process, we can really give, options on how risky you want to be. So
yeah, you're exactly right. A lot of the folks coming in with 401ks, they use those target date funds. And those target date funds could be as close as 2020, but they're 60% in equities. So if you have somebody that's thinking about kind of targeting last year or say it's a 2025, what those target date funds do, folks, is they target when you think you're going to retire and kind of ratchet the percentage of equities, stock exposure, down as you get closer to retirement. So we have people coming in thinking that they've been taken care of by these target date funds, but in reality, if you have 60% of your 401k, Wes, exposed to the market, something crazy happens like last year in the pandemic, market goes down 30-something%. That's a lot of money gone just in a matter of
real quick too. It can happen.
It's crazy. Okay, and then back to these booklets. The one that, of course, everybody, the coined phrase mailbox money. Tony, of course, loves talking about mailbox money. It's something a lot of our clients enjoy, is that guaranteed lifetime income. Mailbox Money for Life is a booklet that came out a couple years ago. We had thousands of people download, request a copy of that booklet. It explains, of course, how insurance products, annuities specifically, can provide guaranteed lifetime income that savers can't outlive. And then lastly, the one I'm working on, Retirement Planning Made Easy, just kind of ties all those things together. Again, if you want to enter the email blast list or want any information about those booklets, email. My email is Trey, Trey, at TonyWalkerFinancial.com. And then Wes, one more time, what's your email?
Yeah, don't leave me out of the fold here. Wes at TonyWalkerFinancial.com.
Yeah.
I'd be happy to get your emails.
We have a contest. Whoever gets the most emails will win. Let Tony get bragging rights on that.
Yeah, get a new sweater vest for one of us. I think, the first to anoint one of us with the sweater vest will be the winner of that competition.
That sounds good.
But yeah, the cool thing about those booklets is they are, like I said, made easy. They're simple reads. You can do them in one sitting. They're pretty easy to digest, so check them out.
Yeah,
You'll like them.
We had a client actually from Northern Kentucky, drove down with their wife. Her wife read the booklet in time before they even made it halfway back to Northern Kentucky. So that
Well, she wasn't behind the wheel though, right?
not driving.
Okay.
Yeah.
Okay, good deal.
We
Yeah.
don't condone that.
We'll warn against that, but that's the only precursor.
But Wes, let's take a break here real quick. We'll be right back. We're going to jump into those CD alternatives. We'll take a break and dive into that.
Sounds good.
Wondering how much money you'll need to retire? Probably a lot less than you think. I'm retirement specialist Tony Walker, and for the past 36 years, I've helped thousands of savers determine when to retire and how much money they'll need in retirement, and I can help you too. So if you're retired or thinking of retiring soon, maybe you know of somebody who doesn't know if they can retire, let me invite you to log on right now to TonyWalkerFinancial.com. We look forward to talking with you soon.
Welcome back, savers, again to the Worry-Free Retirement. This is Trey Juergens, fiduciary here at Tony Walker Financial, with the favorite nephew.
Favorite? I mean, I'm not sure that I am. I think I'm the only one. I'm not sure. I know you're the only son-in-law. I'm pretty sure of that. But it's interesting being the favorites when kind of first pole position there.
By default is fine with me. But,
yeah, I'll take it.
Again, being the favorite and being fiduciaries, I want to again just kind of back up in the fact that when we became advisors, we had two crazy events happen. I think it was actually the week of my, once I became approved as a fiduciary and an investment advisor in Kentucky and Indiana, the next week was when it all hit the fan. The market dropped significantly. Here I am, able to give investment advice, and
what do you tell them?
Yeah, first time ever we've had a pandemic just absolutely rattle the market. And then, of course, you joined as a fiduciary here middle of last year. When did you become registered?
Let's see. Yeah, middle of 2020, just about in there. So, of course, that's an interesting time to be registered as an investment advisor. First year in the business, this was one to really find your roots in.
Yeah.
So,
now you're exactly right. And then, of course, right after it all happened here, early 2021, we joked about it in the opening of the show, but with the short squeeze and all the craziness around Reddit investors and how the internet can really just take over and allow people to kind of manipulate the market in reality. But again, we are not here to talk about the market in terms of how to strike it big on individual stocks. We're here actually today to talk about 3 CD alternatives. It's a phone call. I know you've received them a lot lately. I take a few a day of folks shopping around for CD rates.
and it's tough because you go down to the bank and the rates they tell you is just not what you want to hear.
Yeah.
I think I could get better money than that hiding it in the sock drawer somewhere.
It really, I mean, yeah, we have clients that are really considering just yanking money out, burying it in the backyard in a coffee can.
And you probably wouldn't make much over that in a CD. So,
yeah.
But we've got a few options that are, some alternatives that perform similar to CDs. They act similar to CDs in the way they're constructed. And, we're excited to tell you about them. So, Trey, what kind of are those three alternatives that we have?
The first one, I kind of joked and said this is as close to the real thing as you can get. It's called a MIGA. It's a multi-year guaranteed annuity.
So it is an annuity contract.
It is. It's backed by an insurance company. It's not backed by a bank. It's not FDIC insured. It's backed by insurance companies who are then backed by the state guarantee fund.
Right.
So that's basically their way of supporting if something happened. If we don't work with any companies that are not A-rated annuity companies, but if something, heaven forbid, happened to the annuity company, you in Indiana and Kentucky are backed up to $250,000.
And two, one thing to note is with these insurance companies, they have a lot stricter requirements as far as how much cash they got to keep in their coffers, how much money they have to keep on hand. They're a lot more stringent than a lot of investment companies. And even through, the financial crisis in '08, a lot of people talk about AIG, which was an insurance company. Now they folded, but their insurance side of their business actually stayed healthy. They didn't have any problems. But the investment side of AIG is actually what went under. So a lot of times they'll hear things, but really when you're talking about insurance products, they are a lot more safe, a lot more guaranteed because of those more stringent requirements that they have.
Yeah, you're exactly right. And insurance companies hate to see insurance companies go under, and they can actually go into what's called receivership, which allows companies to take over contracts, support those contracts in full force. So again, just backing up on the fact that these are safe products, as of the date of this recording, it is February 18th. We have 3-year rates and 5-year rates on these products just as kind of a timestamp. Again, as of February 18th, on a 3-year contract, Wes, we're looking at 2.1%, meaning over 3 years, that's what you get, 2.1. Not a lot of moving parts with a MIGA. Again, it's about as close to a CD as you can get in terms of the insurance world.
And I haven't checked CD rates lately, but I think they're hanging around maybe 1%, maybe a little under this.
You'd be lucky to find 1%.
And just a quick background too, Trey, what controls those rates? I know it has something to do with the Treasury. I know that the government sets interest rates for the Federal Reserve. Kind of how does that work? I know that they set that rate, and then of course banks can lend out at a rate similar to that. But kind of go into those bond yields just real briefly on how that works.
Yeah, so in terms of insurance companies versus banks, banks are pretty much glued to that federal interest rate. With the federal interest rate being next to nothing right now, bank CD rates are next to nothing. With these insurance companies, they are slower to adapt to the falling insurance rates because they're on longer term bond yields, different things. So obviously these rates aren't going to hang around forever. If the federal interest rate stays zero,
right,
all these different yields that they're chasing are also low, but they're not as drastically impacted immediately like CD rates are.
And they're somewhat tied to it. So if we saw an increase in the federal interest rate, say it went up to 5%, you'd probably see the annuity contracts go up as well, but they're not as closely tied to it as those CDs are down at the bank.
Yeah. You're not going to see the insurance companies back in these contracts participating in any short squeezes on the stock market or anything like that. But
pretty safe stuff.
You're exactly right. And then a 5-year rate right now on a MIGA, again, that's a multi-year guaranteed annuity, a 5-year product. Right now we're looking at 2.65. And again, we only use A-rated companies. So if you're hearing other rates out there, you might be, but we're not going to go with any company that's not A-rated.
Yeah, make sure to check for that because a B in school is pretty good, but a B with an insurance company, think twice.
Yep. And then let's get to the second option. Again, that first option's a MIGA, multi-year guarantee annuity. As I said, it's the closest to the real thing as you can get right now in terms of comparing CD rates. Number two, there's kind of a qualifier here, and I know it's something you work a lot in. It's a life insurance contract. So we're looking at someone that will be able to pass through medical underwriting because these insurance companies, life insurance is the only insurance that pays out premiums plus interest to somebody. It's likely not going to be you because you're going to be dead and gone.
Be tough to, yeah. You wouldn't want that money shoved down in the grave anyway.
Yeah, but let me set up the situation we typically hear. Trey, this isn't money that I really need. It's money I want to leave on to my kids. First thought as an insurance salesman, okay, life insurance, that sounds pretty good. The next thing is the rates aren't going to be necessarily guaranteed in a MIGA forever. They don't plan on touching it forever. So we think maybe this is something that life insurance would be good for.
Absolutely.
Single premium life insurance, single premium whole life insurance, where the dividend participates. Let me know when your eyes are glazing over with this. But it's a way that you can cut a check to a life insurance company. It sometimes can double the money. Right here, I'm going to pass you over some forms here. I'll hand you, this is Jill Saver. She's a 65-year-old female. That would be taking $50,000 and cutting a check. Insurance company, of course, she's been medically underwritten and approved for standard ratings. And go ahead and show me what is the death benefit that first year immediately if she cuts that check.
Okay, so year one, she's paid in $50,000. Let's say she's to pass on in year one, God forbid to poor Mrs. Saver, but her death benefit would be $101,020. So immediately, that's a 100% return. You could go out in the stock market and try and take that with some risk, or you could just buy life insurance and know that one day you're going to make that return. Now, of course, over time, you live longer, that return shortens up, but it's guaranteed.
Yeah, so that, I mean, we like that for that situation. So if someone's out there shopping CDs knowing that they're actually in pretty good health, this money is not money they're ever going to need to touch.
And they don't care to touch the money.
Why not consider something like this?
And two, with this dividend participating, like you talk about, the death benefit grows over time. So the company we work with has paid a dividend for, I don't know, 100 years, something like
115 consecutive years.
This pretty consistent dividend. So if you look at year 10 on this life insurance illustration, she's only paid in that $50,000. That's the only money she's ever put in the life insurance company. But in year 10, at her age 75, say she was to pass on then, she'd have about $110,000 in death benefit. So it's made a little bit of an increase over time, and that death benefit is guaranteed and tax-free.
Yeah, say she changes her mind on this. Say she needs that money back. By year 3 or 4, she's going to have cash value to be able to walk away from the policy, surrender the death benefit, of course, but she's free and clear. She doesn't have to stick with this thing. Of course, her son or daughter, whoever her beneficiaries are, they like that big tax-free check after she would pass away versus...
They might be in her ear a little bit saying, hey, Jill Saver, make sure to not cash that thing in too early.
Yeah, and then real quick, just if Joe Saver, let's say 65-year-old male, again, standard non-tobacco ratings, as of the date of this recording, would cut a check over to an insurance company for $50,000, his initial death benefit would be $92,000 and some change. So
they always give the breaks to the ladies, don't they?
They're statistically going to live
statistically,
longer.
those ladies, they'll live a little bit longer. Probably smarter than us, Trey. I mean, if we're being honest, that might be what it is.
So these are, again, this is an option situation being that you want to leave the most money to your beneficiaries as you can. Don't plan to touch this money. CD rates aren't what they were. If you're healthy, considering putting somewhere to maximize what you leave to your kids. Single premium whole life insurance is not a bad option.
Sure. And even if you just wanted to pay over time regular whole life insurance, we can do what's called guaranteed universal life. So that's where you've got, a permanent policy, but you're just going to pay on it like a term policy. And it's usually cheaper than the traditional whole life, but we can look at any of those options for you. Again, if you're interested in some life insurance, email me or Trey, Wes at Tony Walker Financial or Trey at Tony Walker Financial.
Perfect. So then we're going to go to a break. We're going to come back with one insurance product specifically that Tony's been renowned for the last 20 years, really. But we're going to come back. Let's take a break real quick, and we'll get to that third alternative to CDs.
Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. With the stock market at all-time highs and our nation's debt through the roof, there's a lot of uncertainty out there. Now may be the best time to safeguard more of your 401k. Let's get started today by logging on to TonyWalkerFinancial.com.
All right, and we're back. This is Wes Walker with Tony Walker Financial, here with Trey Juergens. I'm the favorite nephew. He's the favorite son-in-law. We've gone through that a couple times, but just make sure you know who we are. So we're going to talk about one more alternative to CD rates down at the bank. So we've discussed two alternatives. We know CD rates aren't that high right now. We discussed multi-year guaranteed annuities, MIGA contracts. We talked about life insurance, and there's one more product that we've got that Tony's pretty renowned for. And Trey, what is that?
It is fixed indexed annuities.
FIAs.
Yep. So it's similar to fixed annuities. However, these get to participate in the stock market without any market risk.
Yeah, so a lot of times when we'll use a lot of times fixed index annuities in the planning process, a lot of times for accumulation, safe accumulation. You know, if there's a big market drop, you're not going to lose any of the money that you've put into the contract. Now, you may not gain anything. You may just return a 0%, but that's a heck of a lot better, especially when you're getting close to retirement, to taking a 30, 40% loss. And you also get to participate in the market up to a certain percentage. So just for reference, let's say there's a 40% participation rate on an annuity. The market goes up 10%, and you would get 4% credited to your contract. That's just kind of the nuts and bolts of how a fixed indexed annuity works. We won't get into income riders. Sometimes we'll put those on in the planning process, but just speaking on alternatives to CDs, how do these fixed indexed annuity contracts work?
Yeah, so the types of contracts we like for this specific situation, again, not to go too much behind the curtain, but if someone's suitable for an annuity, again, these are not suitable investments for everyone. So we don't want everybody to go and, as we say here lately, don't get stuck in the wrong annuity. We want people to understand what they've got. We have a ton of educational material for savers to understand annuities. The big one being Annuities Made Easy. It's on the website. Again, that's TonyWalkerFinancial.com. If you go there on the homepage, kind of the portal pages, there in the middle of the homepage, you can click on Annuities Made Easy. We have just a ton of content explaining these products.
Now, are these as safe as those multi-year guaranteed we talked about? Because I know those are just, you put your money in, you get some interest every year. Do I have any, risk of loss of principal with these fixed index annuities?
That's a good question. So these are indexed to the stock market, like you just mentioned. You are given a list of indices, which of course we help select those as your advisor, hoping that you're going to make the most money. You are not guaranteed a fixed rate. So you're not guaranteed, like we said with a MIGA right now, 3 years at 2.1. You are not guaranteed in this fixed index annuity to make a guaranteed rate.
But you might have the opportunity to make a little higher return, right?
You're exactly right. So as the market does well and your contract is credited interest, it could do better than 2.1. Not guaranteed to, but what it can guarantee is you won't lose any money.
Bottom line, not going to lose any money.
Exactly.
And that's the bottom line.
And that's what savers are looking for. They're not interested in crazy returns on their money. They're guaranteed just to get their money back at least.
Just to hit it one more time, it's not about the return on your money. Sometimes as a saver, it's really just about the return of your money with a little bit of interest on top.
Cool thing too with some of these fixed index annuities lately is they have what's called an enhanced death benefit. So if it's someone that's not necessarily healthy enough to consider life insurance, it's got a little extra bang for your buck to leave it to your kids. But
sweet.
Yeah, as we come to a close, Wes, I appreciate your help here on the radio show.
Yeah, it's been a good time. It's interesting to sit behind the almighty throne of Tony Walker.
I know. We're not the little man in the sweater vest. Again, this is Trey Juergens and Wes Walker, fellow fiduciaries here at Tony Walker Financial. Wes, again, just thank you, and let us know if anything we can do to help you. You can email me at trey@TonyWalkerFinancial.com. Wes, your email?
Wes@TonyWalkerFinancial.com. And remember the YouTube channel too. We've got a ton of videos, educational content on there. And then if you'd go to the blog page on the website, we've got some stuff on there as well. So plenty of resources to check out.
If you're looking for a time to meet or go over your situation by phone, TonyWalkerFinancial.com. Click on that Let's Get Started button, and we thank you for listening.
If you got it, you don't need it. If you need it, you don't got it. You don't get it. it, shame on you. Funny, funny, funny what money can do.